Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. Now, it sounds a bit weird to say that a $60 billion plus company is cheap. Yet, that's exactly how we would describe FedEx. And with earnings scheduled for March 17th, we expect FedEx to outperform the market over the next year. Even though it's the second most searched integrated freight and logistics stock amongst financial pros, we expect that volume to pick up as we near March 17th. You see, FedEx is already down more than 20% from its all-time highs last April, while United Postal Service made new all-time highs last week. In fact, FedEx trades below its highs from 2016 to 2018. Now, you might think that signals relative weakness, but for a company trading at less than 13 times next year's earnings and 7 times next year's cash flow, we see it as a discount. And pricing power allowed the company to increase rates an average of 5.4%, which we expect to help maintain margins. Here's how it all fits together. Headquartered out of Memphis, Tennessee, FedEx Corp is a global leader in logistics, and as just mentioned, management plans to implement price increases this year. We also want to highlight management's long-term financial goals. These are important given what we expect to be a profitable yet challenging environment in the coming years. A 10 to 15% EPS growth per year for a company of FedEx's size would be huge, as would a 10% operating margin. We'd like to see the focus on both improving cash flows and returning value to shareholders. Revenue-wise, FedEx has a 10-year average growth of 7.89%, which was barely down in 2020 before accelerating to 21.3% in 2021. That's on top of a net income 10-year average growth of 13.67% and EPS of 15.58%. Interestingly, margins slipped in more recent quarters from the high watermark in May of 2021, but are still above historical averages. And that's why the company's focus on a 10% operating margin could be a huge boon to shareholders. We're also delighted to see capital expenditures come down as a percentage of revenues. That shows management's tight fiscal control in place to keep cash flows growing. Lastly, we want to highlight the company's long-term debt of $20.4 billion and capital leases of $13.96 billion, compared to the $6.83 billion in cash on hand. While those levels are a bit high, with the amount of cash generated each year, they don't place a heavy burden on the balance sheet. And, to demonstrate how cheap FedEx is, we compared it to its peers, and the results were eye-opening. Basic valuations show that FedEx trades at a discount to the majority of its peers. But when we look at the growth metrics, we find more reasons to be bullish about FedEx. We also think a key selling point for FedEx is the company's relative profitability. Compared to its peers, FedEx boasts the highest margins in nearly every category, with the exception of net income and EBITDA. And even then, it's still just slightly lower. In our opinion, this is an 8 out of 10 stock. FedEx is a fantastic company with a strong vision for the future. Like others, they face labor headwinds and cost challenges. Yet, management's focus on margins should keep these in line until external pressures ease. And that's when the real climb in shares should begin. Click and subscribe to the Spill newsletter to get the full breakdown.